Right, good afternoon, everyone. Thank you very much for joining this Goldman Sachs webinar on Asia Macro and our first take on this morning's tariff announcement. My name is Michael Snaith. I look after Asia Research Merchandising at Goldman in Hong Kong. And today I am delighted to be joined by my colleagues Andrew Tilton, who's our Chief Asia Pacific Economist, and Danny Suwanapruti, who's the Head of Asia Emerging Markets Foreign Exchange and Rate Strategy. Over the next 25 to 30 minutes, we'll start with Andrew on the broad top-down implications for Asia from the announcements on tariffs this morning. We'll then move across to Danny for his thoughts around FX and rates, and then we'll wrap up with some Q&A. Please don't hesitate to put any questions you have into the Zoom Q&A box at the bottom of your screens, and we'll build them into the discussions towards the back end of the call. Before we get going, just need to read a quick disclaimer, please. This call is strictly for clients of Goldman Sachs only. It is not intended for media and is off the record. If you're not a client of Goldman Sachs or you've not received an invitation to join this call directly from Goldman Sachs, you should hang up now. Good. Let me hand over to Andrew, please.
Great. Thank you very much. And thanks to all of you for joining. It certainly was a dramatic announcement from the White House overnight. This represents the largest increase in tariffs in multiple generations, really almost a century, and a worse than expected one from the Asia perspective. I'm going to run through what exactly the administration did, then some of the implications for Asian economies before turning it over to Danny. First, the administration will impose a 10% across-the-board tariff on all countries, with the exception of USMCA compliant trade with Canada and Mexico. On top of that, the administration, the U.S. Trade Representative, has calculated the tariff rate necessary, in their view, to balance trade between the U.S. and other countries. And without going into all of the details of that calculation, the basic idea is the bigger the surplus a foreign country runs with the U.S. relative to the volume of trade, the bigger the tariffs the U.S. imposes. The U.S. representative does have a kind of fact sheet out of this explaining their methodology. Because many Asian economies run large surpluses with the U.S., Asian economies have tended to be hit worse by the tariffs than most other regions. So that's the first main point. Asia hit worse than expected. Relative to what clients were discussing prior to yesterday or prior to the announcement, we think the rest of the world is broadly as expected. Most people were discussing a potential tariff range of 10 to 20%, and that's what we got in much of the rest of the world. For Canada and Mexico, the tariffs are clearly lower than expected, in essence zero for all but the non-compliant trade, which is a very small portion of Canadian and Mexican trade with the U.S. Our U.S. team calculates that the new tariffs average out at a 18.3% increase if you weight them by U.S. imports, but the increase in the effective tariff rate would likely be around 12.6 percentage points. And the reason for that is due to product exclusions. So this is where it gets even a bit more complicated. The new tariff rates don't apply to certain product categories that will have their own specific tariffs. So steel and aluminum and autos, for example, already had product-specific tariffs. The reciprocal tariffs won't add to those. And the U.S. has also identified a few other sectors, semiconductors and pharmaceuticals among them, where these new tariffs announced overnight will not be applicable, presumably because more tariffs are forthcoming in those categories. Again, from an Asia perspective, the tariffs are clearly bigger than expected. If we can show the chart, please, just to share the numbers for this region. This just indicates the rates that the incremental rates, importantly, not the total rates, the incremental added rates in each country. Again, these won't apply to a few specific product categories, including autos, steel, and aluminum, but they will be additive to all other categories. In particular, in economies that were already facing significant tariffs, notably China, these will be additive, for example, to the 20% tariff already imposed earlier this year by the administration. So to summarize, it's essentially a 10% tariff floor on all countries except Canada and Mexico, and then higher tariffs for countries that are running significant trade surpluses with the US. And again, many of those are in Asia. The administration has indicated some willingness to negotiate, presumably, given the manner in which the tariffs were calculated. Negotiations would involve potential purchase deals from the U.S., reductions in foreign tariffs on U.S. Goods, or other measures to try to narrow the trade surplus of a particular foreign economy with the U.S. We assume that the 10% rate will be a floor. That won't be negotiable is our assumption. But in our estimates of how we're thinking about the potential growth impacts, we will assume that there will be some room for negotiation, and we will see some of the very high tariffs negotiated partly lower. I think it's safe to say that there is downside risk to our growth forecasts in a number of regional economies. We haven't made any formal forecast changes as yet, although we did change some numbers last week following our U.S. team's adjustment in their assumptions pre this announcement. I think the biggest risks are obviously where the tariff increases have been highest and where trade is a larger fraction of the economy's GDP. So these tend to be in smaller open economies in Asia that are very export oriented. And in particular, looking at the chart here, Vietnam, Thailand would be a couple of those most likely to be hit, both because they're facing a high tariff rate and because they have a high share of tariffs to GDP. In terms of inflation, we don't expect significant impacts on inflation because we don't think most economies will retaliate. The incentives to retaliate are very low unless it's possible to impose significant pain on the U.S. and get U.S. policymakers to rethink. In Asia, we really think China's the only place that will retaliate in any significant way, and we expect that to look somewhat like it did last time. Very targeted tariffs, perhaps some incremental export controls and or company-specific actions, but not broad-based tariffs. And again, we don't expect retaliation in any significant way from other Asian economies. So the net inflation impact should be low or even negative to the extent that surplus goods capacity will have to be redistributed outside the U.S. So negative impact for growth, negative for, on the margin at least, for inflation from these tariffs. I'm going to pause there and hand it over to Michael and Danny.
Thanks, Andrew. Firstly on the market reaction, and then where from here, just off the bat, basically dollar is lower versus G10, dollar is higher versus CNY, and dollar Asia is higher, and we've had lower rates across the board. Just digging into that a bit more, on the G10 side, most of the move seems to be concentrated on the euro or euro dollar, so dollar weakening there, and then obviously a dollar yen has had quite a big move as well. And across the board is generally a lower dollar reaction versus G10 currencies. Coming back to our region in Asia, the focus this morning was on the dollar CNY fixing, and that came in slightly higher actually, specifically 7.1889. That's actually 96 pips higher than the previous fixing. And if you look at the size of the move day on day, this was actually one of the largest moves we've had definitely since inauguration and going back to around towards the end of last year. So that is slightly different if you compare to the two previous rounds of tariff announcements in early February and March. But since then, the fixing has actually been very stable at 7.17, 7.18. So today's move did show that the PBOC did allow a little bit more flexibility there. And on the spot, we've crept back up at least momentarily earlier this morning above 7.3, which is a level we hadn't seen there for a while. So overall message is dollar down, dollar CNY up, and the PBOC does allow a little bit more flexibility than we've seen compared to early episodes of tariff announcements. On rates, 10-year US is now at 4.04. That's down quite a bit from the day before 4.22. And just looking back, 30 basis points lower from just a week ago. So quite a significant move in core rates. And Asia rates across the board here CGBs in China 5 to 8, Sing 4 to 5, and Thai baht 2 to 5, and Korea slightly lower. Indonesia's closed, and India is just opening, but so flattish so far. So rates obviously reacting in a sort of risk-off manner across the board in Asia. Going forward, our G10 FX team has been highlighting that on the broad dollar first, it's generally been more two-way risk at the moment anyway. I think that's sort of the message. Coming into the year, the theme was very much focused on US exceptionalism, weaker growth outlook in Europe, weaker growth outlook in China, and tariffs would be dollar positive. That's sort of the very core, I say, consensus view coming into the year, and definitely the feedback we got from our macro conference in Hong Kong. However, a lot of that has shifted now. Obviously, our own US team has revised down their growth expectations in the US. Europe's had a story of a fiscal boost, particularly from Germany, and China growth activity has actually been holding up despite 2 rounds of tariff announcements. So the growth dynamics has shifted. Tariffs in isolation, if ceteris paribus, then yes, that is typically dollar positive. But as I mentioned just now, it's not all things equal, and that there are differences in growth expectations on the US versus the rest of the world as well. So I'd say on the dollar, a broad dollar is more two-way risk now from here going forward, and obviously more scope for downside as we've seen in the reaction so far today. On dollar CNY itself, as we've looked back, I mean, that China's been a little more restrained in their retaliation, as Andrew mentioned, and our China econ team has written about. And I would say that the policymakers there have several tools at their disposal to offset growth: monetary, fiscal, credit, housing, and FX is just one tool. So we don't think they'll rely significantly on FX. We've already flattened our dollar CNY forecasts. We're expecting 7.3, 735 on a 3, 6, 12-month horizon. So we've kind of reached there in our 3-month forecast already today. So the next level we're looking at is 735. But as of now, as available information, we're not expecting any large depreciation, because obviously PBOC, we think, will prefer FX stability as the main focus going forward. So that's going to provide an anchor for the rest of dollar Asia. Elsewhere in the region, in terms of FX, so what happened this morning, where we go from here? Dollar yen obviously a lot lower as the yen rallied, given its typical safe haven attributes. And then in the region, we've had the 2 outperformers that we've seen, and Philippine peso we've seen so far this morning. I'd say that's intuitive, given that the chart that Andrew just showed, Singapore is only facing a 10% tariff, which is lower compared to the rest of the region. And Philippines, as we've been cited in our previous research, is relatively more insulated compared when you look at exports exposure to the US compared to the rest of the region. So those 2 currencies outperforming, I say, is intuitive. And the underperformers this morning was CNY, Ringgit, Korea, Thai baht, all fairly exposed to the US. I think in terms of trading strategy, what we've been recommending for some weeks now is that given the FX, it is two-way risk, is more difficult to predict, and given there are many moving parts in the DM side and EM side and tariff side, I think for us the message has been long duration. So most of our trade recommendations has been in that theme. I think the top-down message, even coming into the year from our outlooks, is that Asian central banks generally would like to cut rates. Growth has generally been slowing, is looking to slow going forward. Inflation is coming down, and central banks would like to cut, and rates are now still in several places are still above neutrals. In order to get back there to normalize, they would like to ease, but FX has been a constraint previously, or at least a worry about that. And in case in point, for example, Bank Indonesia have been very focused on FX. But given the growth outlook going forward, and I think that dollar Asia probably is somewhat anchored, given our expectations on dollar CNY, we think long duration is a preferred strategy here. So trade recommendations we have on is receive 2-year swaps in India, long 1-year SRBIs in Indonesia, which is basically the front end, and Korea steepness 2s10s in swaps, which is effectively an expression of a bull steepening view. Maybe I'll pause there. Michael, maybe pass back to you for Q&A.
Awesome. Thank you, Danny. Thank you, Andrew. Just to remind the audience, please put any questions you have into the Zoom Q&A box, and we will get to them now in the 10 or so minutes we have left. Andrew, maybe if I start with you, and as you can see from a number of the questions coming in, there is a fair amount of confusion as exactly what all of the tariff announcements meant this morning and potentially the implications. So where do we sort of sit? We came into this thinking 15% effective tax rate. Coming out of this morning's announcements is, are we lower but worse for Asia? Maybe we could just try and unpick a couple of the moving parts and provide a little bit of clarity where we can.
Yeah, sure. Our U.S. team and our global team expected the total increase in the effective U.S. tariff rate this year to be 15%. That includes tariffs announced before now. So the assumption of where we ended up out of today was perhaps a 15% announcement, but given product and country exclusions, which I've mentioned, Canada, Mexico, and a variety of products, that was going to be lower. So just to be very clear, this announcement was bigger than we expected in terms of the tariffs, mainly because of the very high tariffs on Asian economies. We think with today's announcement, the average effective U.S. tariff rate, not the increase, but the total is around 19%, close to 19%. And, would likely go a little bit higher with the incremental tariffs if and when they're announced on semiconductors, pharma, and so forth. That said, I think, if you want to find anything positive here, it's that these tariff rates do represent, kind of a starting point for negotiating and probably an upper bound, barring any retaliation. So the increase today was definitely bigger than we expected. I think bigger than anyone expected. But probably is the ceiling outside of a couple of the specific products that I mentioned, and there is some room for negotiating down from here.
Thank you, Andrew. And so just sticking with you, the number of questions, I think, around, potential path forward from Asian governments, Asian central banks from here. You talked a little bit about, kind of fitting into two camps about companies that would have to ultimately negotiate versus those that may take a firmer stance. Do you feel that, China is going to pull that domestic lever a bit heavier or more forcefully as a result of what's going on?
Yeah, I mean, we had said, in our forecast coming into the year that we anticipated Chinese policymakers would, calibrate stimulus to the degree of the tariff shock, and that if tariffs were higher than we expected, they would pull the fiscal lever in particular harder. So I think this, clearly meets that bar. We had anticipated a 20% increase in Chinese tariffs. We had that prior to today. Now we more than doubled that. So I think it's very likely that China runs a larger fiscal deficit, even larger than the one we had previously been assuming. In fairness, and we had noted this in last week, that exports were tracking a little ahead of our assumptions in first quarter growth as well. So we had seen actually some upside risks emerging to our 4.5% real GDP growth forecast for the year. Clearly, those have swung to the downside, but we think that the policy will fill at least some of that gap, and in particular, I would expect it to be fiscal policy first and foremost. In terms of other economies, I think that clearly the implications tilt in the same direction: negative for growth, very very slightly negative for inflation. So that would imply easier policy on the fiscal and or monetary front. Some places are constrained by statutory deficit caps or other fiscal targets. Some central banks may feel a little bit of caution because they desire to keep relatively stable FX. But if, as Danny mentioned, China probably tries to keep the renminbi fairly stable, that can be somewhat of an anchor for regional currencies. And we think, the implications would be, on balance, slightly looser monetary policy than we would have gotten.
Thank you, Andrew. And Danny, just turning to you for a second, obviously you mentioned, the upward, downward pressure, appreciation pressure on the yen. Like if that continues, how do you see that kind of the implications for the rest of Asia? Typically, yen strength has been pretty deflationary for the rest of Asia. Like, how do you think that plays out if we continue to see yen trading better?
Yeah, so we did this analysis before because there was a point last year where there was a tear between dollar yen and dollar CNY. And so we did the correlations on this, going back sort of 20 years and just see basically where's the higher beta. If dollar yen goes goes up, dollar CNY goes down, where does Asian currencies go? And the answer is, to us, very clear. It's dollar CNY, right? So I think 20 years plus ago, dollar yen was a key driver of Asian FX. Now dollar CNY is clearly the main anchor here. So where in what situations does dollar yen basically reflect its sort of safe haven status is basically when US equity is down and US real rates goes down, which is basically what's happening now. So the reaction, I'd say, is intuitive. Going forward, dollar yen, given the current theme we're in, probably does continue to go lower, at least there's some momentum. But as I mentioned, dollar CNY is going up, or has gone up at least this morning. And given they've kind of held it there, we don't think there'll be, to be clear, we do not think there'll be a large move, as Andrew has said, but some slight upward move is warranted, and we've seen that already. So I think dollar Asia will follow dollar CNY, and that's basically been the reaction today, and I think that continues.
Understood. Thank you, Danny. Andrew, question for you on just kind of thinking through some of these second order impacts. To the extent that higher tariffs are passed on through prices to US consumer, like what is the risk on the demand side, and how should one think about that?
Yeah, I mean, we'd think of several potential channels of impact on the U.S. First and foremost, it's a real income hit. Stuff costs more for the same income. You have less real income, less purchasing power. So that's a hit to demand. And there's also, other channels we've looked at include, increase in trade uncertainty. Arguably, that was already very high and didn't increase further here. And on the plus side, the reduction, the improvement in the net trade balance. So those would be some of the key channels of impact on the U.S. But we would expect to see lower real consumption growth as a result of the tariffs. And I think this isn't really so as easy to quantify, but the complexity of what has been done and the fact that the uncertainty still hasn't been resolved is probably also at least marginally unhelpful in terms of restoring business investment. So, as has been discussed already, there is some possibility that some of these tariffs could be negotiated down. But at the same time, there are also a couple of product categories where we may still get product-specific tariffs. So we're still living with some uncertainty here. I think the main thing that's been capped is we're probably not going to get an increase in broad-based tariffs going forward, but we're far from getting complete clarity on the tariff regime. And while that's the case, it's probably a net negative for business investment as well.
I appreciate it. It's still pretty hard to make this call, but if you were to sort of handicap in terms of where you think some of these tariffs move to over the course of the next week or so before the additional tariffs and reciprocal tariffs become effective, how do you think about that, and how's the team starting to think about that?
Well, I mean, I think there's a little bit of a bandwidth issue, from the standpoint of U.S. policymakers, because you have everybody in the world's going to be calling them up, trying to have a conversation. So I don't know how far we can get in a week, but I think, we would think about the tariff increases in two parts. There's this sort of universal 10%, which we think of as kind of a baseline, and we think that's probably not very negotiable. Then there's this incremental tariff on top of that, where other countries have very large, surpluses with the U.S. That looks more negotiable, especially if other countries can convince the U.S. that they're going to be able to, in some way, shape, or form, lower that imbalance, either by importing more from the U.S., paying more for U.S. imports, or exporting less. So I think there is some scope. I mean, I think as a working assumption, and I would not claim any deep insight here, we're assuming that, of the gap between whatever number it is, let's say 34% for China and the 10%, so call that the incremental 24% due to the reciprocal tariff calculation. Some portion of that, less than half, maybe somewhere between a quarter and a half, is probably going to be negotiable. That's sort of a working assumption that we're using as we think about what the growth effects might be. But that's also consistent with how our U.S. team framed it last week when they increased their tariff assumptions that, probably wherever we started isn't exactly where we'd end up. But that's, I think that's clearly, as with many things, still uncertain. I think, are we likely to see these tariffs chopped in half? that seems like a probably too optimistic of an assumption, at least in the near term.
Understood. Thank you, Andrew. I think that's probably a good place to pause. I appreciate there are many unanswered questions, both from today's announcement and some of what we've got in so far. But thank you very much to the audience for dialing in. Please don't hesitate to reach out to Andrew, Danny, or even myself. We'd be more than happy to follow up offline. Thank you very much to Team Goldman for your comments this afternoon, and wishing everyone a great back end of the week. Thank you.